Lenovo, the Hong Kong-listed computer maker, recently announced its third quarter results. They talked about record high quarterly revenue and pre-tax profit. We were intrigued. We've been skeptical of their accounting for a while and thought it was worth checking to see what, if anything, had changed. A few things were quite clear. Most of their growth looks to have been acquisition-driven and comes from Asia outside China. Whereas in China, their home market, revenue continues to drop. The data center business is losing less money, but that's possibly because it's shrinking. Finally, nearly all revenue is still at point of sale rather than over time, i.e. it's not subscription basis. There is limited evidence that the business is being transformed. Our first take is that the results look dull but not disastrous. This changed when we started looking into the detail. What we discovered reminded us of the Noble Group, and it's starting to look like there could be fraud. Lenovo may be in for a very tough year. But before we go on, I must remind you that under Hong Kong SFC regulations, we can't make stock recommendations to the public, and none of what follows should be taken as investment advice. At the recent results, Lenovo gave an upbeat presentation of the past, but expressed concern about their next quarter because of disruptions in China. We think they're glossing over some very important issues. To help illustrate these and see what might be motivating management, we're going to use our standard governance, accounting and peer performance framework. Governance. Lenovo is controlled and managed by the Hong Kong listed Legend Holdings. This is important because Legend is a highly levered holding company that's borrowed against its stake in Lenovo. It's hard to see this in Legend's accounts because it fully consolidates Lenovo's business despite only having a 29% stake. This makes Legend appear to be a self-standing viable company, but without the dividend from Lenovo, we think it would be unable to pay its interest costs and would have to restructure. We assume that this is why Lenovo has continued to pay dividends since financial year 2015 despite being consistently cash flow negative. Normally you'd expect the independent directors to protect the needs of the company and prevent such a cash draining strategy. Moreover, Lenovo's board has plenty of registered independents, many of whom have served with well-known companies. The problem is they've been on the board a long time, and we're not convinced that any will really challenge the Legend appointees. Accounting. Lenovo's receivables are growing worryingly fast. In Q3, they were up 2.3 billion versus last year, and that's with virtually no revenue growth. This seems a little odd. Why is Lenovo struggling to get paid at a time of record profits? And if they're selling to customers that can't pay in the good times, how badly will things go if China consumption slows? The next problem is that despite this rise in receivables, their bad debt provision has actually fallen. Surely if customers are taking longer to pay, you'd want to be more, not less cautious. The only reason that we can think of to be less cautious is that a prudent bad debt provision would wipe out the growth and profits, making it extremely difficult to raise finance and so prevent the payment of dividends. This receivable growth doesn't show up in headline cash flows simply because it's being offset by rising payables, i.e. Lenovo is delaying payment to its own suppliers. You may be able to get away with this in the good times, but in the bad times, suppliers will usually choose to service other customers or go bust. These are signs of stress, but not necessarily fraud. However, the changing invoice pattern is of grave concern. For years, orders have flowed fairly evenly throughout the quarter, which is exactly what you'd expect for a non-seasonal product. But recently this has changed, and over the last year, 40 to 45% of the quarter's sales appear to occur in the last month. This makes little sense unless customers are being persuaded to make extra purchases late in the quarter. This could be channel stuffing to meet sales targets, or, worryingly, invoices could be being reissued to cover non-payment, i.e. being evergreen, either of which would be of grave concern. Evergreening is interesting because the new invoice has to keep growing to cover both the previous non-payment and the appearance of new sales. This on its own could explain why unpaid receivables are rising. The problem may be even worse than it appears because they use factoring to reduce the receivable balance and boost cash levels. Unlike others, they don't reveal the factored balance, which allows them to manufacture a net debt figure at will and obscure their real situation. We note that year on year, factoring costs have more than doubled, giving some indication of the stress the balance sheet is under. To get some idea of what is happening, we adjusted reported net debt for our estimate of the factored balance and trade payables. It's then quite clear that their operating liabilities are steadily rising, and Lenovo is getting slower and slower at paying its bills. We also looked at non-trade payables and note that these are also rising. Lenovo seems to be desperately trying to preserve cash on the balance sheet. Performance. To talk about record revenue and growth is factually correct, but it misses the point because much of the growth has come from acquisition. To really understand the poor quality of its organic business, look at China. This is Lenovo's home market, and revenue has fallen nearly every year since 2015, even though the economy has surged. We're not even sure that management believes in the growth story because the money owed to suppliers has fallen sharply in the last 2 quarters. quarters. This is important because Lenovo manages its working capital by trading with its subcontractors. To avoid holding inventory, it sells components to the subcontractors and then buys back the completed products when they have orders. This minimizes reported working capital, but it should also give a guide to management's expectations for near-term orders. A rising balance should precede rising sales and vice versa. The problem is that this balance has been in a downward trend since 2017 and, as we mentioned earlier, has fallen very sharply in the last 2 quarters. Exactly the opposite of what we would expect if management truly believes volumes are going to rise. Of course, if revenue is being faked, falling subcontractor orders would make perfect sense. All of this is somewhat at odds with their talk of growth, profits and financial health. If you want to dig into some of the issues we've covered, please visit the Lenovo page on our website using the links below. There you can see some of the questions we think investors should ask and download some of the recent filings where we've highlighted some of the key areas. Alternatively, to keep up to date with our reviews, please subscribe to our channel or send us an email. Before you go, please remember, none of this should be taken as investment advice. We've sourced our facts from the company documents, but the interpretation and conclusions are just our opinion. We provide these videos for education purposes to expose what we perceive to be creative accounting. They are subjective and should not be used as a basis for an investment. Thank you for your time.